Assalamualaikum. Welcome to video 20 IAS 37. So in IAS 37 there are three things that we are going to account for: provision, contingent liability and contingent asset. A standard which always comes in almost all the exams, both for SBR and FR. So a provision is a liability of an uncertain timing or amount. Provision must be recognized when entity has a present obligation as a result of past event, probable that outflow of economic benefits will result, and reliable estimate of the obligation can be made. Okay, so the amount that is recognized as a provision is the best estimate of the expenditure that are required to settle the provision. When the time value of money is material, you have to discount your provision to the present value. And where the time value of money is not material, you don't have to discount. Mostly it is material, okay, that's an assumption, and we discount the provision to the present value, and they will always give you the discount factor, so you don't have to worry at all. Now, IAS 37 is giving specific guidance in several areas. Provision for future operating loss. So they say provision for future operating loss you cannot recognize because they do not result as a past event. Okay. Next, a restructuring provision. Restructuring provision you can only recognize when an entity has a constructive obligation to carry out the restructuring. That means they have a detailed formal plan in place and also they have informed the affected people of the construction plan. Then only you can recognize a restructuring provision. Okay. So how do you know that there's a detailed formal plan that is taking place? For example, you have mentioned what is the location, what is the function, what is the number of employees who will be made redundant, when the plan will be implemented, you are setting the date, the time and the expenditure that has been incurred, okay, and you are announcing to the people who are going to get affected by this plan. Next, a decommissioning provision. You have to recognize it in relation to the asset when there is an obligation to remove the asset after the end of its useful life and restore the site to its original state. Often you will see this decommissioning provision. Okay, for example, oil rig or a nuclear power plant. Now, so from provision, let's move on to the next, which is contingent liability. Contingent liability is a possible obligation that can arise from past event and whose existence will only be confirmed by an uncertain future event which is outside the entity's control. Contingent liability should not be recognized. Okay, you will only disclose if there's a possibility of transfer of economic benefit. But if the possibility of transfer of economic benefit is remote, you disclose it. You only disclose it. But if it's not remote, if it's very likely that there will be a transfer of economic benefit, then you have to recognize the contingent liability. Otherwise, you do not recognize. So you have to see the probability of the transfer of economic benefit. This they will give you in the exam, whether there's a high probability, low probability. Okay. Contingent asset. Contingent asset is also a possible asset that arises from the past event. Existence will be confirmed by the uncertain future event outside the entity's control. Contingent asset should not be recognized. We usually do not recognize contingent asset, like how we recognize contingent liability. So if the possibility of inflow of your economic benefit is probable, that means you are very sure that you are going to receive the benefit, then only you disclose the contingent asset. Okay. Now, example 1. So a company is making an announcement to its employee that they intend to restructure. They are involving, okay, redundancy to be made in one department and other restructuring cost to be incurred. So the announcement was made on 28th March 2005. Company has the year end 31st March 2005. That means before the year end, they have made the announcement. Now, in this case, a restructuring provision should be recognized because the announcement was made before the year end. So it is a constructive obligation now that you have to restructure. Example 2. Company is publishing their annual report. Okay. Publishes in its annual report their impact on the environment and the actions that they are taking to minimize the damage. So the company has a well-documented record of taking full responsibility. On 1st October, 2005, the company published its annual report. Okay, publishes in its annual report their impact on the environment and the actions that they are taking to minimize the damage. So the company has a well-documented record of taking full responsibility. On 1st October company has brought a machine into use at the cost of 10 million. Now that machine is causing damage to the local land. So the cost of repairing it is 2 million. Machine has to be disassembled and decommissioned on 30th September. Interest rate is 8%. Okay, so now what should you do? You have to find the present value. Okay, this is when from 1st October 2004 to 30th September 2007. For 3 years you have to discount the cost of repairing, that is 2 million at 8%. So this is how you do it. Okay, first understand whether you have to recognize a provision or not. In this case you have to recognize a provision. Why? Because bringing the machinery to use and causing the damage to the local land are result that the machine are being operational. Okay, they are operational. This is a past event. Company is well documented also. That means it is creating a constructive obligation that they have to repair the damage. Therefore, you have to recognize a provision. When you first brought the machine into use, whatever the damage has been caused, you have to recognize a provision to that amount. That amount of the damage is 2 million. Interest is 8%. This is to the power 3, not 1.083. It is 1.08 to the power 3. So the provision is 1.59 million. Okay, so the cost of provision will be debited to your property, plant and equipment as the part of the cost of that asset. Remember, it will increase your cost of property, plant and equipment. And each year your provision will be unbound to increase the carrying amount of the liability, and an interest expense will be recognized in the statement of profit and loss. See, like any liability, provision is what? It's a liability. So that liability you have to find the interest also. So every year that provision will increase by the interest liability expense. How do we get that interest expense? Same rate that you have used to discount, 8%. That 8% you will apply on your present value. That is 1.58 is your amount of provision multiplied with 8%. The amount that you get is your interest expense that goes into your statement of profit and loss, and also you have to add it with your provision, which will increase your carrying amount. Okay, so you keep on adding like this, 8% with 1.59 for the first year, second year, third year. At the third year your value should be 2 million, and 2 million is your future value. Okay, now any further damage that is done in the subsequent period, you can only recognize once the damage has been caused, as future damage can be avoided. See, you have to have the damage. You can't write a provision for future damage that is going to occur. It has to have occurred first. Without the damage being caused, you can't recognize it. Why? Because future damage you can avoid if the machine is decommissioned before 2007. Because as such there is no present obligation. Because no present obligation, no provision. Now example 3. So it's about company's warehouse being damaged in a fire. Now company is making a claim that its insurance will cover the cost of repairing the warehouse and replacing the assets that are damaged in the fire. So at the year end, company has not received any confirmation from the insurance company whether the insurance claim will be successful or not. And there is no reason to assume that the claim will not be paid. So in this case, until the insurance claim, see what is your insurance claim? It's a please understand the nature of the item, whether it's a provision, contingent asset or liability. This is something that you have to receive, insurance claim. So it's an asset for you. So it's about contingent asset. So until you are virtually certain that you are going to receive the insurance claim, you can't recognize a contingent asset in the statement of financial position. Okay. If it is considered probable that the claim will be settled, you can't recognize, but yes, you can disclose it in the notes. The contingent asset, detailing the amount that you expect to receive from the insurance company. Now, exam kit questions that you have to do, these are the 4 questions that you can do: Meheran, Colette, Rubel and Wink. Thank you for watching, and make sure that you do enough questions on IAS 37. You will get a lot of questions on IAS 37 from your past papers, and also revision kit questions. And I shall see you in the next standard, that is IAS 38 intangible asset.